Welcome to our Taking Stock video for the week ending the 19th of April 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Portfolio Manager, Matthew Swartz, to stream to your Think Share Market. Great to be back this week after we had to organise the masterclass event in Sydney, and it was wonderful to see our clients face to face, Matt. We do have such beautiful and loyal members, and I thoroughly enjoyed the day talking to them. And how are you, Matt? And how did you find it?
Yeah, it was a really good event, Ken, that we hosted up there on Tuesday this week. It's been a long week, and we're ready to do it all over again here in Melbourne next. And lots going on in markets that we'll get into today.
Yeah, looking forward to Melbourne event next week. But before we get started, just a quick yet important reminder: the information we provide today is generic in nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile and any past performance figures shouldn't be relied upon as a guide for future performance. Well, Matt, talking about the markets, what's your take on them this week?
Yeah, it's been a whirlwind of behaviour, I think, in both the US and Australian markets this week. And it does appear as though momentum in markets is starting to wane as higher than expected inflation numbers in the US combined with some economic resilience. And those data points have all but washed away, I think, any hopes of rate cuts in the near term. In the US, consumer prices data for the month of March was higher than expected for a third straight month, providing strong indications that the inflation rate may have plateaued at a level well above the Fed's target of 2%. And meanwhile, here in Australia, the unemployment rate came out yesterday, and that still remains tight, coming in below expectations at 3.8%.
Yeah, we've been talking about these risks, about the risks of sticky inflation and also stronger economic data like the jobs market. That's why bond markets have sold off drastically. You know, when you're looking at the 10-year Treasury bond notes, the yields have progressed back towards that 5% level that we saw during that correction phase in August to October 2023, Matt.
Yeah, we're getting back to that sort of territory, and yet markets are still sort of near enough to their all-time highs, albeit it has been a much weaker period for equities over the course of the last 7 days. But rising bond yields are a reflection that bond investors are becoming nervous about inflation. If you recall, Jerome Powell has continued to point towards rate cuts this year, despite the fact that inflation is beginning to see signs of potential re-acceleration. So bond investors are rightly concerned that the Fed may actually may yield to this political pressure that you get during an election year and cut rates anyway, which would inevitably provide a stimulatory impulse that could make inflation even worse. So at current levels, we obviously believe that the share market remains overextended, and we have previously advised members to look at taking profits, especially across stocks that rallied strongly following the reporting period. And within our managed funds, we continue to hold a full hedge position to protect our clients from volatility across the markets.
Yeah, certainly risks emerging in the marketplace, and not to mention the geopolitical risk still in the Middle East. But moving across to some of our stock highlights for the week, BHP and Rio released their quarterly updates. They are currently not star stocks, Matt, but given that many investors may have exposure to these stocks, could you perhaps provide some insight into those announcements?
Yeah, sure. It appears that most of the news was in line with consensus, Ken. BHP's iron ore business, for example, was slightly ahead of expectations, but this time it was its coal division, which was the slight letdown, I guess, of the combined result. And as a combination of wet weather and maintenance impacted this coal business. And Rio was a bit of the same. Its iron ore division was in line, but its copper division disappointed due to some damages to a conveyor belt at its Kennecott mine. So importantly, both companies maintain guidance across its key divisions, which is why the market didn't appear to react too strongly either way.
Yeah, with both miners maintaining their guidance, though, the question on everyone's lips, Matt, is what is the outlook for their dividends across these well-held stocks? Keep in mind that we don't currently have them within the star income universe. Currently, consensus is anticipating a gross dividend yield of 7.5% for both miners.
Which may be a tad high. And one thing that's clear from management commentary was both companies are focused on investing for growth. And remember, the dividends are the result of a highly abnormal period driven by record iron ore prices and very little capex during and after COVID. And Dan Ortiz, our resource analyst, continues to believe that while dividends remain above the market, they will continue to trend downwards. And if commodity prices do come under pressure, the level of payouts to shareholders will probably disappoint.
Yeah, and a final reminder that Dan does still back Star Income stock, Datira Royalties for income due to its unique royalty style business. And the stock price has come down in recent weeks, but has a more attractive gross dividend yield at 9.4%. Also, Matt, another stock to gain a bit of attention this week was ResMed Limited. RMD's the code here. The company was sold down following some news about the effectiveness of weight loss drugs on patients with sleep apnea.
They can't seem to avoid this thematic, can they, ResMed? American pharmaceutical company Eli Lilly's phase 3 trial showed that its weight loss drug, tirzepatide, significantly reduces severity of obstructive sleep apnea in obese individuals. And this improvement was more pronounced when tirzepatide was used in conjunction with CPAP therapy. The results could potentially impact the CPAP device market, as fewer patients might require such devices if the drug's efficacy is confirmed across various levels of sleep apnea severity.
Yeah, so back on that speculative mill we go, Matt. With ResMed's share price, that was sold down slightly this week, but the full impact on CPAP devices, that's not going to be known until there's more detail around the study. In the meantime, though, we are happy to retain the coverage of the company as a star growth stock, but note that the earnings trends remains positive for now.
And Ken, over the week, I have noticed that your team has transitioned annuities provider Challenger from its borderline star growth status to a star growth stock.
Yeah, that's right, Matt. This stock is one of our analyst Ryan Lim's best ideas within the financial space. And the company continues to benefit from this higher for longer interest rate theme, which has translated to increasing demand for its high yield annuity products. And we expect positive earnings revisions to flow through, which should further support its gross dividend yield of around 5.4%. But we'll talk more on this next week. Looking ahead on the corporate calendar, now we've got Woodside Energy. They are expected to have their AGM next week. And after this, we look forward to the bank reporting season expected to begin in May. And now for Under the Microscope this week, we take a closer look at the financial performance of wealth platform operators, Netwealth and Hub24, following their March quarterly updates. Both companies are high quality businesses with strong net profit margins, but Hub24, they are on a return on equity of about 13%, while Netwealth has a return on equity of over 60%. So Matt, what's the key difference between the two?
Well, the primary distinction is that Netwealth focuses solely on platform services, while Hub24 also offers portfolio administration and reporting, as well as self-managed super fund admin through their acquisition of Class Limited in 2022. So this diversification for Hub24 does result in the wide discrepancy between the profitability of both businesses.
That makes sense, Matt, and that probably explains why Netwealth enjoys a net profit margin of around 30% compared to Hub24's 20%, reflecting the lower margins from Hub's additional services. And with regards to the quarterly updates, though, there are two key metrics that really drive this profitability. You've got the growth in funds under administration and also the positive market performances, which have enhanced the asset values in client portfolios.
Yeah, however, though, a notable point made by our analyst Ryan Lim is the explicit warning about the diminishing returns on the incremental funds under administration growth due to its tiered fee structure. This serves as a cautionary signal to the market that current earnings projections might be a little optimistic, especially with regards to the platform margins.
Yeah, for those who want to understand that in more detail, please refer to our commentary. But we've been discussing these risks since we began covering these platforms, especially during the February reporting season. Now, with management directly addressing these issues, it appears that they are suggesting that the market's near-term expectations might be overly optimistic.
And additionally, the recent share price rally fueled by a broad market upturn and softer inflation figures in October suggests that much of the consensus growth numbers have been priced in, with persistent inflation and geopolitical tensions affecting global energy markets, it's prudent to adopt a cautious stance on these businesses.
Yeah, Matt, and given these factors, we have transitioned both Netwealth and Hub24 to our borderline growth star stock portfolio. We've noticed that analysts have begun revising their financial year 24 and 25 earnings estimates lower after this third quarter update, and that's of course driven by management's comments on the platform margins and fee structures as well. So currently the earnings revisions are positive on Stock Doctor, but we expect this to change in coming days.
And with regards to Netwealth, a few members may be wondering how is it possible for its founders, father and son, Michael and Matthew Haynes, are able to hold close to 50% stake in the business apiece. The reason here is that their holdings are represented through a family trust rather than on an individual basis.
And now for question of the week. With bond yields rising on the back of the higher for longer interest rate narrative, a useful question for members this week is, how do bond yields, in other words, interest rate expectations, how do they drive equity market returns?
So purely theoretical, Kien, rising bond yields will have an impact on stock valuations because equity valuations often use discounted cash flow models which estimate the present value of a company's future cash flows. So when the interest rates rise, the present value of future cash flows decreases, leading to lower equity valuations.
That makes sense, Matt. And also, if you think about it, with rising bond yields, the return on bonds becomes more attractive, and that induces more investors away from equities, driving share prices lower. However, in practice, it's not that simple. Rising bond yields can also indicate that the bond market is pricing in a stronger period of economic growth, which in turn helps corporate profitability.
Yeah, it's not that simple as it can. And historically, there tends to be a positive correlation between equity markets and bond yields when interest rates are coming off a low base. But this is highly dependent on what is driving interest rates higher from this low base. Usually, the rise in rates from a low base has been due to expectations for stronger economic growth following an economic downturn. So you can see this with the chart on screen, which looks at the correlation between stock returns and bond yields historically.
Yeah, that's right, Matt. Rising bond yields or interest rate expectations tends to be positive for equity markets when the rates are low. And as you said, Matt, it tends to reflect the improving economy. But when bond yields do reach a certain point, say 4%, and if it continues to rise, then there is this negative impact on equity markets as high interest rates impact valuations and the cost of debt.
Yeah, that's right, Ken. And given that this time around is far more unique than historical forms, because the recent spike in rates has largely been a function of higher than expected inflation. So in our view, this could actually exacerbate the negative impact to equity market returns if bond yields continue to rise from here.
Yeah, thanks, Matt, and hope that helps our members. And if you have any questions, feel free to contact our analyst team or come along for our Lincoln Live session on Monday where Tim, myself, Matt, and Robbie Manfrey will be there to help you. But again, thanks for your insights, Matt. Really appreciate you having on board.
It was my pleasure, Kien. And also a reminder, we will be conducting our masterclass in Melbourne this coming Tuesday, and tickets are selling quite fast. So if you're keen on getting into the nitty-gritty details of how to pick high-quality stocks or even hearing our view on what to expect this year in markets, make sure you contact our office as soon as you can. Our event in Sydney was very well attended, and it was a great opportunity to spend the day with some of our members. So take care and have a happy, healthy, and prosperous week ahead.